All right, what's going on, y'all? Got a got another economic update for y'all. So, in case you don't know, the inflation numbers came out the other day. They came in at about 9.1%, and the expectation was about 8.5%. So, inflation is definitely getting out of hand because this back-to-back months, or maybe the last 3 months now, or so, that inflation numbers were higher than expected. The last 2 months they were way higher than expected. So it's definitely not looking good. But the Fed expected to meet this month. They're expected to raise rates again, and a lot of the consensus in the news is, a 75 basis point hike, and with the inflation numbers being at 9.1% higher than expected, I won't be surprised if they go 100 basis points, because they were usually going 50 basis point hikes, or that was their plan up until last month when those inflation numbers were higher than expected. And then pretty much at the last minute, literally like the day before, that's when the news started circulating that, hey, they're probably going to go 75 basis points. So with these inflation numbers being so high, I won't be surprised if they go 100. However, the bad thing about that is the Fed knows that they can't raise rates too high too fast, because it's gonna shock the markets and crash the markets. But with inflation at 9.1%, even if you raise the funds rate 200 basis points and we're at just under 4%, that's still negative 5% real growth, because inflation is still stealing 5%. So it's basically, do you want to lose 7%, 8%, or do you want to lose 5%? It doesn't really matter. So that's the bad thing about it. So it's pretty much pick your poison. I think we're going into a stagflationary economy where inflation is going to be high and economic growth is going to be down, like the 70s. But I think it's going to be way worse because we have so much more debt. In the 70s, the debt wasn't quite as high. Today, that's not the case. We can't even raise, if we raise rates, in my opinion, to 5%, I think they would crash the entire economy. So what's going to happen in the future, we'll see. As opposed for the real estate market, at least in my market in Erie County, I'm starting to notice the inventory levels rise a lot higher, or not a lot higher, but up to 2020 levels, around pre-2020 levels. We're at right now about 4 months of inventory. And since May of 2020, pretty much when we started to reopen up, at that point, we've had 1 to 2 months of inventory. We've never had more than 2. It was always 1 or 2, 1 or 2, 1 or 2. Now, we went from 1 last month to 4 right now. And up to this point, we only have 90 sales. When last month, we had about 270. So being halfway through the month, if we go the next 15, 16 days and we're at 90 sales again, now we're at 180. That's down, almost what, 30% or so, 30 something percent from month over month. So if we have that significant of a drop off in the summertime, at that's just definitely that's definitely a sign for a slowing economy and just a slowing market in general. And back to the inflation numbers, with that being high, whether they go 75, whether they go 100, mortgage rates are going to rise right behind that. So right now we're at 5.7% for the 30-year fix, and then the adjustable rates, they vary between like 4.3 and 4.8, somewhere in between there. So with those rates, if rates go up to over 2%, which they almost certainly will, now look at those rates possibly being 6, 7, maybe 8%. Don't be surprised if that happens later this year. I won't be surprised if that happens at all. So the market is definitely slowing down. That's good news and bad news. Obviously, that's good for buyers because now they have more options, but it's bad because the rates are going up. So even though prices are slowing down or maybe dropping a little bit, they're not, they've risen so much that you're still going to be paying a ridiculous amount of money either way. Maybe not quite as high, but you're still going to be paying a ridiculous amount of money. And with the market slowing down and people getting priced out, it's definitely going to slow down activity, and a lot of agents, aren't going to have a lot of things to do. So I think sooner, whether it's later this year, the next year, we're going to see some agents, leaving the business. I believe there's like 1.5 million realtors right now. I won't be surprised if we go to 1 million or even less than that. depending on how this inflation stuff looks. And in my opinion, I don't see it getting any better at all. I really don't. So that's just what it is, man. So yeah, that's the situation we're having in the real estate market now. The sellers are figuring out the hard way that their homes, the equity is not there anymore. And I'm seeing a lot of price reductions on top of that. Just yesterday, I believe I saw about 8. And just on Facebook, when I scroll and I see some of these realtors' Facebook pages, and when they market their listings, I'm seeing a lot of them more than usual, more than I've ever seen. They're marketing their listings price reductions. So I'm seeing more and more price reductions by the day. So these sellers they're getting fear of missing out, and they're starting to realize that they missed the market, and they're getting disappointed. Maybe they want to list their house at $200,000, and they said, either the realtors don't realize it, or they themselves are scared. And that's the reason we're seeing those price reductions, because the realtors are not properly informing their buyers or their sellers that, hey Martha, your house is not worth $250,000 anymore. That was 4 months ago. Rates are way higher now. Your house is only worth $220 or $200 or something like that. So nobody wants to tell a seller that. So and if you do tell a seller that, and somebody says, oh yeah, you can list it for $250, they're just gonna go with the agent that lists it for $250. So that's what a lot of agents are up against right now. So the good agents, at least, that's what a lot of them are up against. And then when they list it for $250 and it's on the market for 3 weeks, which is still normal, but not normal in the last 2 years. So when they're on the market 3 weeks, they have to drop their price back down to $225 anyways, or maybe even lower, because the days on market are getting higher and higher. Now everybody's disappointed. So everybody loses in that situation. So that's the market right now, man. That's the situation. Make sure you're informed. Make sure you understand where the market's going on, and wherever your local market is, make sure you understand that. That local market like the back of your hand. So when you're talking to potential clients, you can be informed. You're gonna give them unfortunate news. You're gonna have to tell them, hey, I know 6 months ago that house sold for $150. Well, the market is completely different now. You're probably gonna have to list it at $130 or $120 or whatever the situation is. So they're gonna be annoyed, but if you market the property right, you're still gonna sell it in less than a week. If the home is priced right and it looks good, it's still gonna go fast. That doesn't matter, whatever the market is. So even though there was a lot of hype the last 2 years, understanding how to price a property, it's more important than ever now. If you were pricing ridiculous, you were able to get away with it maybe the last couple of years, but now it's different. So understanding how to price a property is the number one skill, probably one of the top skills you got to understand in this new market that we're headed in now. So that's that, man. Appreciate y'all for stopping by, man. I'm gonna talk to you on the next one.